Good day, traders. Take a second for me and hit the like button and the subscribe button and turn on your notifications for when we release our latest video. Thanks for following and watching. Let's get started. Today, traders, we're talking about hindsight is not a strategy. We're going to be talking about how I plan and prepare and focus on execution every day. Again, mainly on the gold USD cross, but we're going to look at the US majors. The same rules apply. The main reason that I follow gold is because of the movement. There's more movement in gold. We're going to look at the 1 minute and the 5 minute charts and just show how well structured those charts are in comparison to the US majors, but how using the 5 minute or the 50 minute on those major levels over the course of the day can still set up for some excellent 25 and 50 pip moves. Now, the reason we're talking about this today is that, I get this all the time. Anybody can put a chart up and talk about hindsight. But hindsight is you need to walk backwards and understand what your process is, step by step. And we're going to review the simple concepts, the 3-hour window, major round numbers, high and low of the day. And I'm going to emphasize that the same things happen every single day. So hindsight is for the guy who's actually struggling still and frustrated and angry and says it can't be done. And when they see somebody talk about a chart, says that it's all hindsight and that they can do that too. And that's fine, except that there's a process to approach the market every single day that is constant. And that's what you want to create in your trading. And one of the reasons I focus on those three things is that they are constants every single day. We can't argue about what time it is in New York. It's a constant. We can't argue about where the high and the low are heading into a session. They're there already. They're printed for us. And we know our major round numbers. Now we're going to go over that and review that. I get a lot of questions about what I mean by major round numbers, double zeros and 50s. Now it's price. It's strictly price. It doesn't matter what instrument you're on. 50 cents, 500, 1,000, 100. It's all the same. Major round numbers, whether we're on a daily chart, whether we're on a 1 minute or a 15 minute, the numbers are the numbers. So the planning and preparing and execution each session is what allows you to have a thesis going in for either selling high, buying low, or maybe not doing anything and letting the market trade further to set up a larger picture or a bigger picture over the course of a day, which we'll talk about that with the US majors and with gold, and how that can create larger asymmetrical risk reward opportunities. So hindsight is not a strategy. But when you have a plan, we'll just fix that, and you prepare properly each session and then being able to execute in live time, this is a performance-driven skill set. So the biggest difference between traders that are consistent, if they're trading live, and traders that aren't consistent may have nothing to do with their knowledge about the markets. And I speak to traders all the time who know a ton about the markets, but they're not executing in live time. And part of that is their lack of proper preparation in terms of intentional live time practice, intentional preparation based on what they're going to do in live time. So looking back at a chart gives you the information you need to deconstruct where your weaknesses are if you're not seeing the trades in live time, and then in the next opportunity, working on that, working on how you could have identified that opportunity better in live time. How could you identify the next opportunity better in live time? What rituals and routines are going to put you in a peak performance trader state of mind? So, I have an issue sometimes with a lot of the questions I get. Like one of the questions I have for myself, everything is shut off when I'm trading. I block everything out. And so one of my questions is are you trading for entertainment or are you training to be a highly skilled professional? There are trade setups that are very straightforward and wouldn't require a lot of focus probably to hit them. I would say that those aren't common. There are some really obvious ones. But are you trying to prove that you're right, or are you trying to make money? And so when I'm trading, I'm not in chat rooms. I'm not, chatting to 3 or 4 people at once, explaining every little subtle thing that I'm seeing, and why is it that, and why is it this? Is that 3 pushes? Or what do you mean by 3 pushes? What do you mean by round numbers? Well, what do you mean there's 7 minutes left in the 15-minute rotation? All those little things. I'm there to make money. So I try to provide as much information in these videos as possible, but it's for the traders who want to go and enhance their live time skills. So if somebody wants more information, I try to answer those questions, but I try to make this as simple as possible, not only for myself, but for other traders. Now, there's a lot of little things that you cannot learn unless you're at the screen watching and learning and trading that, whether that's on a demo account or with small position sizes. And I said this the other day in a video, don't trade with real money until you know that you have an edge and that you can actually trade it in live time consistently. And then understand that you need to be able to manage yourself, your own emotions. Traders go to the screen, they may have been drinking. They're trading at night, they've had a few wines, they feel a little less risk averse, they're taking on bigger trades, they're not even trading their plan, they jump into the market, they get smashed. Or they've had a fight with their wife or their girlfriend or their partner, significant other, and they go to the screen frustrated, angry, and they do the same thing. Or they're nervous, they're anxious, they're fearful, they don't take the trade because they're scared, they haven't prepared properly or understanding with absolute confidence the trade setup that they're actually looking for. They're just hoping to get into a move and be lucky or be profitable, and no plan on exit or risk management. And again, I can attest to a lot of these things because I've been through a lot of these little hurdles that were personally related. So how I trade in live time, the setups, everything else, we could have 2 traders trading the exact same setups. And I have a colleague, we share information all the time. We see things differently. We enter in sometimes differently. Doesn't mean one's right, one's wrong, but it's the same setup. So even when you understand the setup you're looking for or the opportunity you're looking for, no 2 traders are going to trade it the same. And so when people want to see it live and all these other things, it's like saying I want to watch Michael Jordan shoot free throws all day to prove that he can do it. And then you're going to go out and do it as well. Well, no, you need to be standing at the line, throwing ball after ball, thousands of balls, until it just becomes unconscious confidence, and it's neurologically hardwired into your nervous system. So, a lot of those comments are ridiculous. I take that as being frustrated traders, or they don't have that edge yet, or they haven't been able to actually, maybe they've faced, they're not actually identifying the real problems, which may be in their own actual behavior and performance and emotional mindset when they're at the screen. So coming back to identifying every day, every trade setup has a unique set of variables. No 2 trades are going to be the same. There may be similar setups, buy low, sell high, trend trades, reversal trades, but the variables will all be different. But again, with my approach, the way I look at the market is I'm looking at the high and low of the day, the session. I'm looking at timing very specifically because I'm of a firm belief that the majority of these moves are very much time related and algorithmically controlled to some degree outside of the major volume times. So I'm very, very focused on the number levels, the high-low, and the timing window. So just to clarify that, we'll go and look at timing one more time. Asia, 8 to 11 p.m. Europe and London, 2 to 5 p.m. Sorry, that should be a.m. We'll change that. And New York, 8 to 11 a.m. Now, again, this is New York Eastern Standard Time. My main focus in the majority of cases is that middle hour. Now, there are first-hour trade opportunities. We'll look at an example of that in gold this morning, but we're going to talk about that as well for the Asian session. On a 1-minute chart, on a 1-minute chart, you're going to see 5-minute, 15-minute, and hourly rotational cycles in terms of timings. So again, I talk about using the 1 minute chart once I know the level that I'm looking at, and then I'm looking for the confirmation of that in terms of price behavior at the high or the low. So I may be at the low, but I may need to see that first 5 minutes trade out to confirm that engulfment or that reversal price action pattern. Or maybe it's not quite there yet, even though I'm at the low or at the high, and then I'm in the understanding that there may be 15 more minutes, or I'm in a profitable trade, especially in the U.S. session, and we may have already moved 25, 30 pips, and we still have another 7, 8 minutes to move in that 15-minute cycle. This may have another 25 pips still to move or further. And again, same thing with the hourly rotation. So very important for me to be focusing on time, the time that I'm in the trade and the time that is evolving over the course of that setup. So again, I talk about looking mainly at 50s and double zeros. Now, we may often have volume above 50 or below 50 or above zero, below zero. And it's trapped in a quarter level. And so I look for where the volume is being trapped. Is it being trapped down low or up high? And an expression that I heard from some traders in the States, the death line they call it, where they draw the line, which will often possibly be at a number level where volume is being caught above a level or below a level as we head into that 3-hour window when the equity markets are opening, where they're trapping them further away from the intended move. And we'll look at some specific examples of that as well. So again, focusing for me, high and low of the day, the session, that can be the session as well. And so again, if this is at the end of a window and we're heading into a next window, we may be at the high or low of a session, a new high or new low within a daily high or low. And we'll look at some examples of that as well. So as I'm heading into the new day or into a new session, I want to know, are they working into a low or into the high? Meaning, are they working back into a peak formation, or are they working down, working into a low, working into a low, working into a low for a potential reversal trade or a failed follow-through and consolidation, that sort of thing. This can give us some insight with our timing window if we're looking at a trend trade, reversal trade, or if we're in a trading range. And again, looking for engulfments and pin hammers. And occasionally there's a couple of scenarios. One where, for example, today's payrolls, I don't want to trade in front of the payrolls. There are opportunities where sometimes the market sets up very cleanly to enter in to a news catalyst trade situation. Some of the trades, payrolls is a great example where we often will see wicks on both sides. And so traders get into the market only to be stopped out or to be put into significant heat, which is why I will usually wait at least 5 minutes prior to entering into a major news release, 5 minutes afterwards at the soonest. But there are opportunities where you can have a trade opportunity already in progress, and the news will act as a catalyst in blowing off and completing the move. What I love about gold is the fact that it moves every session. And when you see this enough, you'll start to recognize some of the patterns. We see the market move into the close on Friday. There's no high of the day yet in place. And we see the market up in a quarter level between 75 and double zeros. This pink line again is the Friday, Monday rollover. This setup going into Asia will get traders going long if they're trading on smaller time frames with indicators and whatever. And that's a 50 pip move from start to finish at the open of the 12 candle window. But this is also an example of a low-hanging fruit trade opportunity where we have higher lows all the way up, and we have an extended 25 pip move beyond the double zeros as we head into that middle hour. The last candle up to the high is the first 15 minutes of that equity hour. Again, an example of traders being taken in the wrong direction. So again, I'm using 1 minute charts at these levels, but the 15-minute shows me the highs and the lows. Heading into this, I have my levels drawn, and it's again knowing that you're already up high. You've got higher lows. This is low-hanging fruit for a stop hunt, but also when the market behaves in a certain way, we go 25 pips beyond the double zeros. The first 15 minutes takes us in the false move direction. So again, high and low of the day, double zeros, quarter levels for drop volume, engulfments, and pin hammers. Now, if we go and look at a 1 minute chart, we see our little W formation in the first 15 minutes. Again, 15-minute rotation, and this market pulls away on the first candle of the second 15-minute bar. So again, understanding the timing cycle. This is our W at the beginning of the first hour trade. The market moves up through the previous day's high, which again was not really a high of the day. The market closed at the high and continued to go into consolidation between 0 and 75. So if we back this up, and again, the simplest things. So hindsight is, I don't know, that looks like a high to me, and that looks like a low to me. So I draw my high and my low. The market came down, hit the stops on the higher level lows. So traders were already in the market. They come back and get the stops on the first mouse. They print the W. The W breaks up through the double zeros. And again, the next hour opens on this right after this bullpen candle. So we'll just highlight that. So again, I want to emphasize understanding that you're up high. You're up high. That's the last candle of the first hour. You're up high, and the next hour opens and takes you higher. Then we get a push through the quarter level, a pullback, a follow through, and then the engulfment. And this would be our M. 25 pips above the initial Asian range. So we have a market now that has given us our W and our M formation. They've cleared out the previous day's high. We have other time frame traders in the market, and we also have a death line up at double zeros. I'll call that a death line. Essentially anything, once it comes back through here, all this volume in this second hour is caught. But we also have the low of the day. This is low-hanging fruit way up high from Friday's session. So low-hanging fruit is stops that are easily going to be taken out. And so just coming back to our 15-minute chart, understanding that our next death line will be at 75. And when we close through there, all of this volume from Friday evening and Monday morning are also now caught. And what do we see here? A bear pin hammer. A bear pin hammer for the second 25 plus pip move before they put in a low of the session. So you'll notice that occurs just beyond 50. The market moves back into the gap time, brings traders down into the low of the day below 50, trapping volume again below 50. So our death line in this case would be 50. Once they shift above there, all this volume's caught. So again, we'd be looking for a buy low opportunity. So I don't know about you, but I see a high of the day and a low of the day. Then I know I'm going to be looking at the timing window and the major round numbers, trap volume, and a 25 to 50 pip target. So again, the same scenario plays out every single day. When we head into the Asian rollover, when we see that on Monday, they were obviously working in to form a high, working into the high. There's no peak formation in place yet. They keep working back up into the high, and they go 1, 2, 3 into the high. As we head into Tuesday, okay, they've gone down and put a low of the day in place. They're working back down into the low. First mouse, back into the low, a first bar trade at major round numbers. We have a smaller pattern within a pattern. And again, we have double zeros, 50s, and we have the previous US session high and low. We're inside of that trading range. We work into the low. We get a buy opportunity, which again on the 1 minute formed a W formation. And again, we move into the following session before we put in a high of the day. So we'll look at some major pairs, but the same scenarios are going to happen every single day. And if you're trading on the 1 minute, again, my main focus is when I'm looking to enter into the trade. If you're inside the high and the low, if you're inside of the high and the low, anywhere in here, after that move is already on its way. Great question regarding the volatility and wicks. If you're inside, you could be caught in 25 pip swings. But up at the high and the low, there's going to be very little volatility. It may appear volatile as it's printing, but again, that comes back to developing your skill set in live time and knowing the setups that you're looking for. So looking at the major pairs, typically you won't see obviously the same amount of movement you're going to see on gold. But my approach would still remain the same. Now I talk about following them over a 3-day cycle, especially heading into payrolls, and I'll look, if there is a large move on payrolls, I'm going to look for a 3-day setup into next week. Trapping volume on the move, maybe up high, down low, looking at the daily chart. It's the beginning of the month. Have we started a new monthly cycle? So each day, though, coming back to those basic questions, the high and the low of the day. We look at Friday, Monday. We see the market had a big move up on Friday, and we see volume caught up high. And I'll blow this up, and understanding again the market's working up into the high. They're working into the high. If you're trading the Aussie dollar in Asia, I would be looking at this would be offering potentially a sell setup. Now, again, the difference in volatility from the Aussie dollar to gold, I would be looking over for a larger cycle, perhaps for a bigger move, because you're going to risk, 10 pips for maybe 10 to 20 pips at best. But as the week's evolving, we're again just asking the same questions. High and low of the day, the timing window, major round numbers. We trigger the other time frame traders. We get an engulfment in that middle hour, and we now are trading above zeros. The market proceeds to go down below the zeros. Again, look at where's the low-hanging fruit. Traders that have chased this move up high on Friday night are now stopped out, and then the market proceeds to put in a low of the day. So you can see that on Monday, the Aussie dollar, peak formation high in Asia, peak formation low in London, goes into consolidation. So unless I have one of these extremes tested, this is why I don't want to be inside. You're caught in something, chasing a long or chasing a short, and the market stays there for the next 6, 7, 8 hours before heading into the next day. But then the question again comes up is, are they working down into the low? So we have a peak formation low that's put in place. The market trades down into the low in the U.S. session, pulls back to major round numbers. So where's my death line? Well, if the market trades and closes up above these lower highs in London and the U.S., this volume now, over the course of Monday, Tuesday's Asian session, would all be trapped down low. This is the current high of the week. So they could be trapping volume down underneath of zero, between 0 and 75. We see the market break through during the gap time and then gap up into the open of the Europe window. So this brings up a really important topic that we haven't gone into a lot, but the gap time is exactly that. We see the market gap up, take out the previous day's Asian high, and the market opens up high, just below 50 and above 25. So the market opens up above 25 after a gap up. So again, that first 3 bars, we get an engulfment, but my first bar has taken me further away after a large move up in the gap time. So the market's opening up on a gap. We have traders that are in profit down in this Asian breakout, down low, and the market proceeds to drop down below the first bar of that Europe session, split the box, and work back up into it before engulfing again in our gap time heading into the U.S. session. So high and low of the day. They went up and put a high in place. They drop it down below the high bull, work back up into the high. They're working back up into the high. We're up high. Then the market proceeds to stop hunt down or move down in the U.S. session before locking in a low of the session. Market locks in a low of the session, goes into consolidation. We're at the low of the U.S. session. Our low bear candle is right here. Okay, low bear, high bull. And we see in Asia the market working down into the low of the U.S. window. Working down before pulling away again. We have a new high of the week. Day 3, day 1, day 2, day 3. This could be a trend day. So we see the market engulf. We've made higher highs. The market again trapping volume. Where's our death line? Well, our death line is going to be down here somewhere. So basically underneath of 25. If the market breaks through these lower highs and clears through 25, I get mixed up here. We now have the U.S. and Asian sessions completely underwater. And then they proceed back to the high of the day. They engulf the high of the London session. Traders are selling this. We're looking for the big move down. We have no break in structure. We have no change in the trend. It's a breakout pullback. And then in the gap time, again, does exactly that. It gaps back up inside of the peak formation before breaking through to new highs, pulling back, and continuing that move into the high. So hindsight is one thing, but having a properly prepared plan and going into a session, understanding what you're looking for, and then executing that in live time, you miss it, so what? Learn from it. How could you have done it better? These are the simple things. High and low of the day, timings, major round numbers, trap volume. And then we head into the next day. So regardless of the pair that you're looking at, so let's ask those questions again. We're up high. The market has a high of the day in place. We have our high bull. Okay, so the market has traded below the high bull candle. High bull, low bear. A full complete candle at either end that's been engulfed or broken through. That locks in the high or the low. So we have our high bull in place. The market proceeds to work down and puts in a low of the day on the rollover. So we have our low of the day. We have a low bear. The market breaks up above the low bear before engulfing and proceeds to go lower. So we have a low of the day, but now we're working down into the low. Working down into the low, there's our engulfment. There's our breakout pullback. That's a break in structure. Break in structure, a higher high. After having lows, we get a higher high, breakout pullback. There's our W for the continuation in the gap time of the long trade. So now we're heading into the next session at the high of the day, and the market breaks through the high of the day, consolidates at the high before breaking higher, pulling back, no break in structure, engulfment, 2-bar reversal for the continuation long in the U.S. session. So again, coming back to the major pairs, the volatility is probably going to be a lot less, 25 to 50 pips per session or per day. Obviously, their ADRs will be a bit bigger, but over the course of each session, maybe 25 pip moves. Whereas gold, obviously, you're going to get 25 to 50 pips in each session and maybe 50 to 100 or more in the U.S. session. So just to come back and review. So if we take a look at today's gold, Friday morning, payrolls, we see the market has taken out yesterday's low. They come back down into the low. They pull back. They go back down into that low. They pull back. And we get one push, two pushes, and then we get a creeper down into the low. And that low gives us a small consolidation. So again, coming back to the hindsight, my preparation's the same. High and low of the day. Timings. Major round numbers. Are we trapped down low or are we trapped up high? So I'd love to get some feedback from the hindsight guys who don't like that. But here it is, high and low of the day. We have our reversal, first 15 minutes, false move. If we go to our 1 minute chart, we have our high, we have our low. And again, another example of where we get a middle structure and there's our shortened W. So with any of these trade setups, nothing is guaranteed, nothing is easy. I don't know what they're going to do, but I have a thesis heading in. I know there are stops. I know there are lower highs, but I also know that the bear pin hammer from the first bar of the U.S. session last night was also a profitable trade. He's in the money. And this defies all logic because all the indicators are saying, oh, this is down, this is down, this is down. This is a creeping trend down into the low for an explosive move back up. They've come back up, hit all the lower hanging fruit highs, and gone up far enough to either shake this guy or lady out of their trade or erase a majority of their profits, scare them out of holding on to it, going to break even, whatever that may be. But high and low, consolidation, M's and W's. Timing is everything. Understanding that timing window is key, and most of the explosive moves are going to happen often in that middle hour. They can happen in the first hour, but the second hour will give you a re-entry into an already explosive move if you've missed that trade. Again, understanding the timing cycles, 15-minute rotations, 5-minute rotations, hourly rotations, meaning that it can take a full 5 minutes or 15 minutes for that to set up or complete a move. So if you're in a trade and the 15-minute bar is moving and it's not quite at your profit target, but it's moving in that direction, but it seems to maybe be hesitating or not going, just understand that there may be another 7-8 minutes left in that rotation for that market, and you'll often see this on gold. All of a sudden it'll explode through a level with 4 or 5 minutes left in that bar. Looking for the trap volume up high or down low. That trap volume is what should give you a very good idea if you're being caught on the wrong side. So if you're selling down low in a block of volume, you could be in the trap volume and they're going to be shifting away long. Look at the bigger picture. Where's the high and low of the day? Are they working down into the high? Are they working up into the low? Up into the high or down into the low? And then is there a death line that you can identify where your trade or that trap volume will be underwater and they're all caught and they're in loss? And so again, working into the high, working into the low. Trend reversal, trading range, engulfments, and pin hammers. Looking out for news, either to avoid major news, being in front of major news, or if you're in an existing trade, that the news may act as a catalyst to blow off or exit that trade prior to it exploding and spiking traders out or going against you. Hindsight is not a strategy. Plan, prepare, and then execute your trades. If you miss a trade, figure out how, deconstruct it backwards. How could you have identified that better? Was it timing? Was it levels? Was it price action? Was it just not a good setup? Were you caught with the retail trend? Or were you able to identify the move and perhaps it's a scalable trade setup? Maybe was it a trade setup that you could have maybe traded bigger, or in the future we'll see again and possibly trade bigger? These are the sort of questions that you ask yourself to enhance and hone your skills in live time. So regardless of what somebody does live one time or many times is irrelevant. It's what you're going to be able to do live. What can you do? You're all here to make money. Traders want to make money. Watching other people trade live does not mean that you're going to be able to make money from that. You need to learn from that. Learn from your preparation, your planning, your execution. Where are you being able to extract your edge to the maximum of its potential? So hopefully you got value from today's video, traders. Keep it simple, stay disciplined, duplicate your process. You need to refine the process for yourself that's duplicatable, reproducible on a daily basis, that helps you identify the highest probability opportunities and then be able to scale them up in size. So have a great session. Remember non-farm payrolls tonight, and have a great weekend. Stay disciplined, stay focused, and may the markets
Hi
go
traders, it's Stacey Burke from Stacey Burke Trading.
If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.